Hi there, everyone. This is Keith Singer of Singer Wealth. For all you people who like your money super safe, I'm here to tell you don't buy any more CDs. It's not the right thing to do. Now, I know you like CDs because they are FDIC insured, which is good. It's good that your money is guaranteed by the federal government. However, there are better things that are also guaranteed by the federal government, namely U.S. Treasuries. Okay. There are four reasons why it's better to buy U.S. Treasuries than CDs. Number one, they pay more, right? In early December, U.S. Treasuries are yielding for 1 year about 4.7%, a little bit higher. But if you Google, CDs, you're coming up with 4.2, 4.1 for 1 year. I know Citibank just had one for 4.15 for 1 year. So you can make more interest with the Treasury than a CD. Secondly, it's more flexible. If you buy a 1 year CD, then you're going to have to wait 1 year if you don't want to have penalties for early withdrawals because CDs come with penalties for early withdrawals. With US Treasuries, if you buy a US Treasury and interest rates stay the same or fall, then you can actually get out of your US Treasury at any time without a penalty. And in fact, if interest rates fall, you can get a reward for getting out early from your US Treasury. Now, if interest rates rise, you will have to hold that Treasury until it matures to not have a penalty, just like you would with a CD. But at least there's a chance that you have that additional flexibility. Number three, it's safer. 250,000 FDIC insurance only applies to CDs. There is no limit on US Treasuries. So if you put 250,000 in a CD and you're making 4% interest and your bank goes out of business, yeah, your 250 is covered, but your interest isn't because there's only 250 limit. There's no limit. You can put a million, 5 million, 10 million into US Treasuries, and the federal government will owe you that money plus interest, regardless of what's happening to banks around the world. There's no limit to FDIC insurance. Okay, nothing safer from a credit risk standpoint than putting money directly with the federal government. Finally, taxes. Think about this: 2 year Treasuries that were issued 1 year ago were paying about 0.6 interest, 0.6 of 1%. So if you buy one that was issued 2 years ago that's paying 0.6, you're going to be able to buy that at a discount. You're going to be able to get it for under $96 per share or per bond. And what's going to happen is in a year, it's going to mature at 100. So you're going to get a little bit of interest, which will be taxed as ordinary income, but most of your gain is going to be long-term capital gains if you buy a treasury that was maturing just over a year. Now, if you buy a treasury, a new issue treasury direct, you're going to get taxed full ordinary income. So it's better, I would submit, to buy a treasury that's in the secondary market that you're going to get at a discount and pay capital gains on most of the interest versus paying ordinary income. We know that ordinary income tax rates are much higher than capital gains tax rates. Plus, you may have some losses you can harvest to offset capital gains as well. So if you're interested in keeping your money safe, it's not a great long-term investment because remember, inflation is 8% still. So if you're making 4.7, you're not keeping up with inflation. But for money that you want safe and liquid, it is a good alternative. So call us at 866 Wealthy if you want to learn about how to build a portfolio of short-term US Treasuries.